In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about a new trade policy by Donald Trump which could potentially change how the global economy works. And in the second story of the day, I'll talk about how Dr. Reddy's is currently in a bit of a situation because their exclusive right to one of the star drugs is ending very soon. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is very easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 27th of January. By the way, before we get started, a very quick announcement. See, every evening after the markets close, we put out a no spam after-market report which captures a broad sense of whatever happened in the markets on that day. I'm pretty sure it'll be useful for you if you are a trader, an investor, or someone who's just interested in the markets generally. So do check it out from the link in the description below. Now, on to today's stories. In the first story, let's talk about a new phase of trade policy which many people believe could absolutely change how the global economy works. Now, without a surprise, it is about Donald Trump's tough approach to international trade. Now, I know even though not everybody closely follows the American politics, this particular issue stands out because it can affect every country's economy in many powerful ways. See, in today's world, we are slowly entering a time when trade barriers might go up more quickly and also on a larger scale than it ever did before. Many analysts are saying that the world might see one of the most important shifts in economic policy in multiple decades. So in order to understand why this matters and what's exactly happening, let's take a quick look at how global trade has changed in the recent years. See, after the Second World War, many nations became open to each other's goods and services. And over time, more trade deals were signed and trade became a bigger part of the global economy in general. But around the time of the 2008 financial crisis, we started seeing something a little different. See, instead of trade continuing to grow at the same pace, it began to slow down and even shrink as a share of the world's economic output. Now, this shift is sometimes also called fragmented globalization. In very simple terms, it basically means that companies are not trading as freely as they once used to do. According to data from various sources, global trade peaked at around 50% of the total world GDP a few years ago and has been declining ever since then. Now we have a report from a large Japanese financial institution called Mitsubishi UFJ, often called MUFG also, which explains why a new trade war might look very different from the previous one. This report suggests that in Donald Trump's second tenure as president, he and his team will act much faster than they ever did before. Now, last time, it took a few years for the trade tensions to build. This time around, the people who advise Trump on trade know exactly which tools they can use in order to raise tariffs or to block certain imports. Now, America's legal system gives the president quite a lot of power to do these things without at all having to wait for Congress. These are specific laws like the Section 338 of the Tariff Act and the International Emergency Economic Powers Act, which let the president quickly impose tariffs or other trade barriers with very little delay. Now, during Trump's first term as US president, the US targeted certain specific items like steel or washing machines. But now in the next round, the plan could be to impose universal tariffs on a wide variety of goods from many different countries. This could be a 5% or a 10% tariff on almost everything, and in some cases, it could go to as high as 25 or even 30%. Now, China in particular could face tariffs up to 60% in total, which is enormous, and it might make it nearly impossible for Chinese goods to remain competitive in the American market. But of course, different countries would be affected in multiple different ways. According to MUFG, places like Vietnam, Mexico, Malaysia, Thailand, and India have become more exposed to changes in trade because they trade a lot with both China and the US. The European Union, especially countries like Germany, which heavily rely on exports, could also be hit very hard by these new tariffs. Many people here remember the trade tensions between China and the US a few years back. Back then, China responded to American tariffs by letting its currency weaken, which helped make Chinese exports cheaper and balanced out some of the extra costs from tariffs. But if a second and more intense trade war starts, China might actually do this once again. MUFG predicts that the currency rate could shift to about 7.4 or even 7.5 yuan for $1 if new tariffs reach 40%. Beyond currency moves as well, China has many other ways to push back here. It can limit exports of critical materials which many high-tech industries need, like germanium or gallium. Also, China holds a large amount of US government debt, so selling a small portion of these bonds could cause ripple effects in the American financial markets. And on top of that, China has its own list of companies it can punish by restricting their ability to operate in China or to access certain resources. Now, meanwhile, on the US side, thousands of companies and organizations are already on its entity list. This means they face all sorts of trade limits. Economists have tried to predict what might happen if these extreme tariffs are put into place. One study is suggestive that the world trade overall could shrink by about 10% as compared to what it would have been without such measures. For countries like Canada or Mexico, which depend a lot on exports to the US, their economies could shrink enough to slip into a recession altogether. But interestingly, the US might see fewer immediate problems because it sells less of its goods abroad. For context, exports only make up around 11% of its economy, so it is not as sensitive to trade barriers as countries that export a lot more. Some analysts also point out that Trump might use tariff not to just protect American industries, but also as a leverage in other negotiations. He might raise tariffs on certain European countries unless they spend more money on defense or on Mexico if it does not meet certain demands about immigration. The report also mentions that we must pay very close attention to how China responds as well, because China has made it very clear that it considers some actions absolutely unacceptable, like trying to force the country towards democracy or encouraging independence for Taiwan. If the US crosses these lines, it might as well trigger very strong actions from China. All of this means that we are not simply looking at a repeat of what happened in 2018 and 2019 when the US and China first clashed over trade. This new phase could be faster, wider in scope, and more deeply tied to other political and security issues. In the end, the two biggest economies of the world might keep drifting apart, setting up completely separate systems for technology, investments, and trade. But it is also worth remembering that the global economy has shown a remarkable ability to adapt in the past. Companies can change their supply chains and countries can make new trade agreements with very different partners. Although the short-term effects might be dramatic and more painful, the long-term story may be actually more complicated and could evolve in many unexpected ways. With that, let's move on to the second story of the day and talk about what's happening with Dr. Reddy's. Dr. Reddy's Labs has recently been in the news because the exclusive rights for its star cancer drug Revlimid will expire in January 2026. Now, for your context, Revlimid has been one of Dr. Reddy's biggest revenue drivers in the last couple of years, and it has contributed to as much as 40% of the company's EBITDA. But now, with the expiry of this exclusive right, a major source of revenue is expected to decline sharply, which will create a void which the company will need to fill with new products or with new strategies. And as a result of this fear, Dr. Reddy's stock has already started to take a hit. It dropped nearly 7% right after the company released its Q3 earnings a few days ago, and it dropped even further after that. Now, one potential savior in this entire scenario is the company's bet on the anti-diabetic drug Semaglutide. Now, this drug is expected to launch in some markets, including Canada, in early 2026. But given that the market has reacted quite sharply to this fear, it is very important for us to break down and understand what is exactly happening here. So let's first start with why the loss of Revlimid's exclusivity matters so much and how the pharma industry operates in terms of patents in the first place. Look, whenever a pharmaceutical company develops a new drug, it is basically a huge deal. The process usually takes many years of research and development along with billions of dollars in investment. So in order to make all of this worthwhile, these pharma companies are granted patents which give them exclusive rights to manufacture and sell their drug for a specific period of around 20 years typically. Now, this period of exclusivity allows the company to recover its investments and to also make profits. And during this time, no other company is legally allowed to sell the same drug, which means the prices can also be kept relatively high. Now, Revlimid, which treats various types of cancers, has been one such star drug for Dr. Reddy's. But it's very important to note that Dr. Reddy's was not the one to invent this drug. It was actually created by an American biotech company called Celgene Corporation, and therefore it is them who held the original patent right to this drug and not Dr. Reddy's. But the thing is, Dr. Reddy's challenged these patents in various jurisdictions, and after litigation, they reached a settlement agreement which allowed Dr. Reddy's to sell a limited quantity of this drug starting 2022. But the problem is that this patent and this exclusivity would come to an end in January 2026. This means that any company can manufacture and sell generic versions of this drug, and that could lead to a sharp decline in its price as well as its revenues. Now, in the pharma world, this situation is usually referred to as the patent cliff. And this basically indicates a steep drop in revenue once a patent or an exclusive right expires. Now, the big hope that Dr. Reddy is depending on in order to offset all of this is a drug called Semaglutide. Now, this drug, which is more commonly known by its brand name Ozempic, has been making news globally as a treatment for type 2 diabetes and as a solution for almost magical weight loss. Now, we've spoken about this drug a few times on this show, so if you are interested, do check it out from the links in the description. But back to the story, because of Semaglutide or Ozempic's almost magical abilities, this drug in recent times has become the most sought after drugs in the entire world. So if Dr. Reddy's is able to successfully launch a generic version of Semaglutide, it could possibly offset some of the revenue losses from Revlimid and maybe even meaningfully surpass it over time. But of course, it is not as simple as launching the drug and taking home all the profits. For one, there are hundreds of regulatory hurdles. Dr. Reddy's is planning to launch Semaglutide in Canada in early 2026 and in other markets only after that. But there is always the risk of delays in approvals. And in addition to that, the patent for Semaglutide is currently with this company called Novo Nordisk. And when it expires in 2026, not just Dr. Reddy's, but a lot of pharma players will likely jump onto the opportunity all at once. And the competition in this generic space means that the window of profitability might be relatively short-lived until all other players start to catch up. But that said, one more important angle to consider here is the changing dynamics of the pharma business. See, as patents start to expire, companies are now increasingly focusing on biosimilars and complex genetics, which by the way are harder to develop as products and therefore also face less competition. Dr. Reddy's management has indicated that biosimilars and other innovative drugs are central to their future growth strategy. They are also eyeing a portfolio of 15 to 20 new products in the US over the next few years. But the thing is, these moves usually take a lot of time to materialize and they usually do not guarantee any kind of success. So yes, in the short term, the market remains quite divided on Dr. Reddy's prospects. Some analysts like those at Nuvama are pretty optimistic and they believe that the company can retain a significant portion of its earnings through new launches like Semaglutide, etc. But the others, like those at MK Global, are relatively less confident and they are citing persistent pricing pressures and limited visibility on key launches as a big reason for it. Now, like I said earlier, Dr. Reddy's stock price has already taken a big hit. It dropped nearly 7% after its Q3 earnings were released. So if you are an investor or someone who tracks the markets, this particular ongoing case of Dr. Reddy's is a classic example of the challenges as well as the opportunities in the pharma industry. While the expiration of a major patent is a huge risk, the good part is that it also forces companies to innovate and diversify. And in this case, whether Semaglutide can help Dr. Reddy's bounce back will only be seen with time. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, the Central Consumer Protection Authority or CCPA has sent notices to Ola and Uber after receiving complaints that iPhone users are charged more than Android users for the same routes. This investigation also covers similar pricing practices in other sectors like food delivery and ticket booking apps. Now, in a related development, Apple has also received a notice over user complaints about faster battery drain, overheating, and app malfunctions after installing the iOS 18 Plus update. Union Minister Prahlad Joshi has called both of these situations unfair trade practices, and he has reaffirmed the government's zero tolerance for consumer exploitation. Second, Reliance Industries plans to build the world's largest data center in Jamnagar, Gujarat, and they are partnering with NVIDIA for this. Now, this center will use NVIDIA's Blackwell AI processors, and it is aimed to strengthen India's AI infrastructure and develop AI supercomputers and large models in various regional languages. The government has set aside 10,000 crore rupees to boost AI projects, which signals a goal for India to become a leading AI hub. But that said, hurdles like limited semiconductor manufacturing capacity still remain. The focus on keeping data within India and leveraging strong digital networks underscores the country's commitment to AI advancements. Third, the Indian government is planning to raise its agricultural budget by 15% to 1.75 lakh crore rupees in 2025. This marks the largest increase in 6 years, and it is intended to address stagnant rural incomes and rising food inflation. The agricultural ministry share will go up from 1.23 lakh crore, with funds directed towards improving seed varieties, storage facilities, and increasing the production of pulses, oilseeds, and vegetables. That's all the news and stories I have for you today. I hope you enjoyed the show and maybe learned something new from it today. As usual, this is your host Anurag Bansal signing off. I'll see you in tomorrow's episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.